You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Hello and welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, so we're going to do a little compare and contrast this time around. This week we tried to look at a momentum trade. Well, I should say last week we were looking at doing a momentum trade in Snap by buying out of the money calls, which is something we don't talk too much about here on Options Playbook Radio, but we do try to cover all of the strategies that are in the Options Playbook. So we're going to rehash the trade. The trade did not work out. It was a momentum-based trade. It's part of the reason why we were looking at out of the money options actually to try to manage the risk of the trade. On a chart that looked like it was having a breakout. Maybe the breakout was a little bit too strong and in hindsight, it actually led into a pullback in the underlying stock. So we're going to look at that trade, and then we're going to continue with a momentum-based trade. Recently, we've had, 80% of the companies now have announced earnings through this earnings season. Recently, a lot of the travel stocks, including hotel stocks, any booking stocks online, a lot of those companies announced earnings. And actually, after their earnings announcements, they have done well. And particularly their comments in their meetings after the earnings announcement were positive, strong demand, et cetera, et cetera. So we're going to try to once again do a momentum trade, but it's going to be on a more expensive stock. And because of that, we're going to look at a long call spread. So that's going to be the theme for the podcast today. And right now we are taping Options Playbook Radio on a Tuesday. The markets are open and rocking and rolling. This will be the day that we'll be looking at the stocks, at the quotes, everything. It's going to be now on Tuesday as opposed to Wednesday. We've kind of changed things up a little bit. But with that said, let's go back and look at where Snap is at. So last Tuesday on the 7th with the markets open, we saw Snap trading when we went to place the trade at 12.24. It was up a little bit on the day. Throughout the day, we actually saw the stock meander higher a little bit. And then on the close of the market, we ended up closing right around 12. Well, the low on the day was 12.20. Well, I guess we were pretty close to the low. 12.24 was the low on the day. No, 12.18 was the low on the day. So where we ended up at with the stock, since we put on the trade, the market kind of meandered a little bit higher, a little bit lower, closed close to where we actually put the trade on, right around the noon time on the 7th. But the very next day, the market actually started to drop. So considering it was a momentum-based trade on the 8th, I would have considered getting out. We talked about a 7 to a 10-day time frame, but I definitely would have looked at getting out of the trade on the 9th because the market came all the way down, bounced off the 11 handle, and then we went into the weekend. So I would have gotten out of the trade, probably lost about half my investment, and not taking the risk of the weekend going into the trade. So if we look at it right now, let's rehash exactly what the trade was that we were looking at. A speculative trade in Snap after their earnings report, based off of the fact that we had some good momentum in the chart. So the trade that we looked at was a March 17th expiration. There were 38 days remaining to that expiration date. We were buying an out-of-the-money option with the stock at $12.24. We bought the 14 strike. The market was 54 cents by 56 cents. So looking at buying one option contract, you would have had the risk of $56 plus commission on that trade. If I look at the Ally Invest option chains right now, we see that Snap is currently trading at 1073. It's basically flat on the day. And that option contract is 10 cents by 11 cents. It's still worth selling. I would get out of that trade probably right now. Time decay is going to be a fairly big factor, and it still had a high implied volatility. The implied volatility rate was still up around the 70% level, even though they had announced earnings. So just a volatile stock, a volatile time. We were looking at doing a momentum trade. We went out 38 days in time because we bought an out-of-the-money option contract. We had to pay up a little bit more for that time premium, but we did that. We got a little bit higher delta because when you go further out of the money, you need to go further out in time to get a higher delta. But we did know that after 7 to approximately 10 days, we're probably going to get out of the trade, hoping for the breakthrough above the 13 level, but we did not get that. As a matter of fact, we got a retracement in the stock fairly quickly, which made our decision easily. I would have been out of the trade for the Friday expiration, but if you're still in the trade, you'd be selling it right now. You'd be down 40 cents on that trade, getting out right around 10 cents. So let's compare and contrast. One thing that we talked a little bit about on the Snap trade was looking at a bull call spread, but we had a lower price stock and we were looking at a fairly strong chart, a little bit more bullish on that underlying. So we decided to go with an out-of-the-money call option. And it was an opportunity to talk about what are some of the rules or some of the things you want to think about, not necessarily hard and fast rules, on if the market is making a breakout and you do want to speculate on the trade, what are the things I want to think about when I'm buying an out-of-the-money option contract? So this week, we're going to actually look at bookingholdings.com, the good old, back in the day, the company was known as Priceline. But that stock actually going all the way back to the beginning of the year, had, along with a lot of the other travel companies, has done well. As a matter of fact, we saw Golden Cross, which talk about, from time to time, here on Options Playbook Radio, where you see the 50-day moving average crossing over the 20-day moving average. It's that would be considered a golden cross if it's going to the upside from the 50 crossing over the 200. It would be considered a death cross, which these are just really strong words. But on the downside, if it crossed down below the 200-day moving average. And so right now you actually have the stock is looking strong because you have your ducks in a row. You have the 200-day moving average below the 50-day moving average, which is below the 20-day moving average. That's a sign of a good, solid market. But it's the same scenario that we've had with Snap in that it's had a good, strong move up here since the beginning of the year, since we actually had that golden cross in the underlying stock. And right now it's a little bit in an area of, are we going to go higher or lower? So we're going to look at a momentum-based trade again, strong market in this underlying strong earnings, kind of hoping that we don't get the, sell the news event. Hopefully demand stays strong as everybody has indicated, and we can still see the stock go higher. So once again, as always, this is not meant to be a recommendation. I just want to paint the picture, because if you're looking at stocks that you are looking on a momentum-based trade, the fact that Booking Holdings right now today, as we speak, as I mentioned, the markets are open and rocking and rolling. So right now we see the stock at $2,429.21. It's up a fraction today. Your markets are struggling a little bit with CPI number this morning, trying to decide exactly what that meant. A little bit of a ho-hum number, but markets were up going into it and then down afterwards, a little bit flat now. But with that said, the $2,429.61. So we're going to look at a long call spread. Now, here's the compare and contrast to Snap, which we looked at last week. If we're looking at a long call spread, the timing of the trade is much more important in that if you're correct on your forecast on a long call spread or a bull spread, otherwise known as a vertical spread, if you are correct on your forecast, you want to be correct closer to the expiration dates on the option contracts. So it becomes a lot more tricky to try to pick the strikes and the expirations when you're looking at a long call spread versus just buying an option outright. So, as I mentioned last week, if I'm buying an out-of-the-money option, I want to err to buying a little bit more time, even though I don't plan on being in that option all the way to the expiration, because of the dynamics of an out-of-the-money option contract. The further I go out in time, I get a little bit higher delta, I get a little bit slower rate of decay, but I do have to pay up for it, so I have a little bit more risk. So I'm going to still manage my trade. So that's the way I'm going to approach it. We went out to a 38-day option contract. We used the March 17th expiration last week, and now there's only 31 days left, and I would definitely get out of the trade today. If not, like I said, I would have got out on Friday after it was pretty obvious that the momentum wasn't going to continue with the underlying stock. All right, so bookingholdings.com, we're going to go 10 days. So we said 7 to 10 days last week on Snap. So we're going to, stick with that concept. We're going to look for a momentum trade to the upside. We're looking at a 10-day trade. These are very expensive option contracts. The implied volatility isn't quite as high as it was in Snap. So we actually see implied volatility is right around 44%. But we're going to go a little bit closer to the money. The most at-the-money option contract on the 10-day to expiration call option is trading right around $76. So $7,600 to buy one at-the-money option contract. So we obviously do not want to spend that type of money, especially on a speculative trade. And because of that, it's a no-brainer that we would do a spread in this instance. Not to mention you have fairly wide markets in bookingholdings.com. So a spread is going to help with that trade. So if we just look at the potential move or the expected move, both option contracts are fairly close. Let's call it 75 at the midpoint. So we're looking at about 150-point move is the potential move in the next 10 days. Based off of bookingholdings.com. And so looking at that chart and looking at the potential move on that as we head into the earnings report. So the expiration that we're going to look at is the 10 days to expiration. It will contain their earnings report. They're going to be announcing on the 23rd. I don't necessarily need to be into this trade all the way up until the 23rd. If I can get a strong move to the upside, I'm okay with it. We're going to manage our risk by doing the spread. As I mentioned, the options are really expensive. And because of that, we're going to look at only a 10-point wide spread. We want to make sure it's within the expected move. So we are buying to open the February 24th expiration, 2,500 strike call, and at the same time selling to open that same expiration, February 24th, 2,510 strike call. We're going to do this for a net debit of $2.30 to the account. That's $230 plus commission to put the trade on. That would be the midpoint. They're fairly wide markets going into earnings, but they're also fairly high volume. So because of the earnings, these option contracts are getting a little bit of action. And I do think that it'll make it executing at the midpoint a little bit easier. There's never a guarantee of a midpoint fill, but I want to trade somewhere around that just because I want to have the decent risk reward ratio. So we'd be risking $230. The width of the spread is 10. So you have 10 minus 230 or $7.70 or $770 worth of upside. Now, if we get the momentum to continue from the other earnings reports that have happened in this space, then we could look to get out of the trade. I'm not looking for the home run of $7.70. If we could be up $1 or $2 on this trade, I'm definitely going to consider getting out before the earnings. But we do still have that earnings date that if the markets, if you choose, and the market's been kind of ho-hum going into earnings, you could ride this into earnings and potentially get that huge move. One of the biggest things about it is they announce on a Thursday, and this has a February 24th expiration. So the option contracts will have 1 day to live. And if you are correct on your forecast, it is feasible that you could make the $7.70 if the market does finish above that short strike of 25.10. All right. So looked at an out-of-the-money call option on Snap as a momentum trade after earnings, much more enticing. Looking at a long call spread before earnings, still a momentum play, much more expensive stock. Would never consider buying just an option outright in this underlying. And it's interesting because we're coming into earnings. We would like to get the risk off the table before the earnings report, but we do have that earnings report if you did want to speculate on solid earnings going into that report. You have 1 day for these option contracts to live after that earnings report. So that's it for this episode of Options Playbook Radio. If you have any questions you'd like to ask me, you can email me directly at theoptionsguy@invest.ally.com. Also follow me on Twitter. My handle is @BrianOverby. We'll see you same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.